Greetings, everyone. Happy Monday, July the 13th. Coming at you with our weekly market update. And finally, after a few months of a little bit calmer weather, it might be time to get back to some dicey waters here. So, right now, the bull trend is still intact. We'll look at the charts here in a few minutes. But the big question is going to be, is that still the case tomorrow at this time, or 48 hours from now, or 72 hours from now at this time? Who knows? Obviously, that's a little open-ended question that shows my bias, but again, we will have to watch the price movement here over the next few days. So we'll go right into the charts, look at the price targets from last week, how everything held up. We did have one false breakout, and I'll walk you guys through that, the first actual false breakout we've had in the last few months. And then we'll look forward at the updated price targets, what everything's looking like. But everything as of right now is unfolding. I mean, I couldn't have laid it all out more accurately if I was from the future and went back in time. You know, with the sell-off we had at the end of the day today, if that really ends up being the catalyst and the initial spark to the downside, it happened almost on the exact day that you guys have heard me talking about for the last 3 months, right? So we'll kind of look at everything and see, and then again, we have to watch everything unfold, but I'll walk through why exactly it looks like that might have panned out almost perfectly. We'll look at the bank earnings this week, and then the big key with earnings, it's at the very bottom of this screen here, is going to come down to where are companies able to cut costs, and when they release their earnings, what are they going to do to be able to do that? And we'll look at a few examples so you can see how actually concerning this piece of the puzzle is and why it could be such a catalyst for things to be not so pretty in the marketplace. So we'll do that. We'll talk about some fundamentals, and then we'll wrap it all up. So without further ado, let's hop right over to the charts. Here's the S&P 500 futures on the 6-hour chart, which is what we've been using for the last few weeks since everything started consolidating. It's a little bit easier, as you know, from last week than looking at the 2-hour. And the one false breakout we had was this 3175 level that we've been talking about since we had this initial sell-off. And if you remember back, it was about a little over a month ago that we had this initial sell-off, actually over a month ago, right? I told you this was just a pullback during an uptrend, and that before we would see a change in trend, we would see it turn around, go up, and then test somewhere near these old highs, but not quite make them before selling off further. And so that price target that we've been looking at for the last few weeks was this 3175. And if you look today, we actually eclipsed that, but this is the definition now of a false breakout. So there's been a few videos where I've showed you guys that there were some potential ones that we needed to keep an eye on, but that didn't really match the criteria. This matches the criteria of a false breakout, okay? So this has been a point of support before and resistance. Support here, became resistance here. And then when it broke up through, number one, you can see it didn't do so on great volume, but it finally did so during the day. And then as soon as we popped up, it immediately turned back around and had a strong volume and price move against it to the downside and went right back below that same price level. So this is the definition of a false breakout. So that is definitely something to be alertive of as the trend continues to stay up. We just now are on alert that I would really expect to see this continue to the downside now, especially with that first impulse move being down. So what caused this today? First and foremost, if you weren't paying attention to the news, this weekend, Atlanta went back to phase 1 of their quarantine plan, and today, at the end of the day, California decided to do the same thing. So one of the reasons that I mentioned here that couldn't have timed this more accurately if I tried was because 2 weeks ago in the weekly update I gave you guys, I said, hey, the one thing that would be really concerning that could really trigger this sell-off to happen again would be if states have to reclose and go back to the first stage of quarantine, because Trump has shown that he's not going to do anything that really edits what's happening with the COVID narrative. He's still out there today even flaunting that nobody should even care about it and that we've beat it and time to move on, right? But the governors and mayors, the people that actually are making decisions for their states, they have to think about the citizens of their state and decide what's best for them. And so them choosing to close down, if this is now a domino effect, it could be really, really ugly for the market. And that was exactly what I mentioned to you guys a few weeks ago. So now we really need to be on alert. If you start to see other states, even if they don't go back to phase one, but if you start to see more and more states backtracking and sliding back now that a few states have kind of set a precedent that it's okay to go back into quarantine mode, things should get, well, not should, we'll say, could get very dicey. Again, we always play the price movement and what we see happening buying, selling wise, but it definitely doesn't look pretty if that would be the case. So let's hop over to the daily chart here real quick of the SPY, the daily S&P ETF. What I mentioned to you guys last week about an island gap reversal. We had this island that broke away, gap to the upside, gap to the downside. And then even though today it looked like we were going to eclipse this and actually carry on up, and this was going to be a false island break, the fact that we wicked and then went all the way back down, this is now still valid. We never eclipsed where this gap open was from the downside break. So until we eclipse that, it still holds true, right? So if tomorrow we turn right back around and pop up and close up here, then this island is no longer valid. But even though today really looked like it was going to break through it, it actually is a further point of validity for this island gap breakaway. So if all of that is the case and we do end up continuing down, what's our initial profit targets and price levels to the downside? Well, on the SPY, this 296 level is going to be pretty strong. This is where we had a low, obviously, here that we broke up through, that we were looking at back at Memorial Day weekend. That would be the first point of emphasis. And then let's actually switch back to the 6 hour. That'll be easier to see. So we'll have to zoom all the way kind of out here. This is what I was just telling you about. This first that we broke up through this 29.75 level, right? This would probably potentially be one around 28.88, and then the full one to the downside, if we had a huge big bloodbath, a big longer term target would be this 26.30, 26.40 level, would be one to really keep an eye on. But again, we need to see a new low come in order for this to be a downtrend. So I'm giving you guys all this analysis based on what my view of things are, and if stuff happened based on logic, what we would expect to see. But as we've seen for the last few months, until we see it, don't jump all in short, because we're definitely still in an uptrend, but we are not making new highs. We did not make a new high today, so we haven't set a new high since back a little over a month ago. So we've continued to stay in this consolidation pattern. So what other things are causing me such concern about the downside movement? Well, just a refresher, this is, again, the time that I've been calling out since March that I really thought something could be triggered to spark the next sell-off, and that really comes in the form of earnings, because back in the day when we were really selling off hard, right back through here, this was all speculative selling of people panicked and terrified, number one, of not only of what the virus was going to do from a health standpoint, but from a corporate health standpoint. How poorly affected are companies going to be if they have to shut down and quarantine and send, fire a bunch of employees and not make any revenue, right? And so when we finally bottom out, this is where investors at the time believed that the overall value of the market was based on what their expectations for companies were going to be. And this will be the first time that we really see whether or not these expectations fall into line with what people were thinking. So if earnings are way better than expected down there, then it's been the right thing that the market has moved to the upside. If they're way worse, then it definitely gives more validity to the fact that the market is severely overvalued at the moment. But either way, this is the first chance, besides the GDP number, that we get to see an actual data point that gives some form of glimpse into how detrimental this COVID situation has been financially to companies' bottom lines in 2020. But what's more important than that, and always is more important than that for us looking at earnings, is what companies give as their guidance going forward, right? Because the stock market is made up of what people expect in the future. That's what makes them decide if we want to buy now. If I think Apple is going to be worth $200 a share in 2 years and it's $100 a share today, I'm going to buy it not based on what its value is today. Maybe it's only worth $90 today. I'm willing to pay $100 because I think in 2 years I'm going to be able to sell it for $200, right? That is what the stock market is. So the guidance piece of things and what companies say about what they project for Q3, Q4, and the entire first year is going to really be the key piece of information that gives us a glimpse into how bad this situation has really hit some of our biggest and most favorite companies. And that leads into this main question that I put at the bottom here, and that is, where are companies going to choose to cut costs if they're in too much debt? So I haven't gone into a ton of dialogue in these videos about the corporate debt bubble, but literally you could just Google corporate debt bubble and you're going to get more information than you could probably handle about it. But the long and short of it is, it has been very, very easy for companies to get liquidity and gain capital over the last decade plus, that companies are so over leveraged that they're in some trouble if they have to cut part of their business off. And rather than trying to put it into words, I'm going to show you an example. If we look at somebody that I personally think is in big, big trouble, and I'm going to make a very bold suggestion and say it publicly on here, and that I think one of the major airlines will go completely out of business based on this whole situation. And it very well could be American Airlines. And let's look at why I'm saying. All right, so I went ahead and paused it there just to get this pulled up, but you can just go to Yahoo Finance and get companies' financials. But we're going to keep it super simple. I'm not going to go into a ton of detail here, but look at American Airlines, and I want you to just look at their revenue. All right, so for the last few years, right, 45 billion, 44 billion, 42 billion in annual total revenue. And you could go to their balance sheet and look at their EBITDA and do all these different, short-term loans versus long-term debt, all this sort of stuff. But what I think it sums it up even more and even simpler is if you just Googled how much debt does American Airlines have. Let's just see. Boom, and you don't even have to do any research, okay? American Airlines, as of May 20th, has 34 billion in debt. They have recently gotten close to another $20 billion in loans. So they're probably a little bit closer to $50 billion right now in debt. And if you go back to their financials, they make, when they're operating at 100% efficiency over the last few years, they make a max of 45 billion in revenue. That presents a really, really big problem. And so companies like American can't necessarily afford to get any smaller, right? They need every penny of that revenue just to pay interest on their debts, not even the debts themselves. And so you have United came out, I believe it was last week, and said they're cutting 40% of their workforce. Well, how can a company like American, who already is more in debt than the revenue they make, they can't afford to cut 40% of their business. They're screwed if they do that, right? So the travel industry, which flights might not go back to really normal for at least a year, 18 months, what is a company like American going to do to be able to stay afloat? And that's really going to be the key question for not just them, they're just one example, but of all these corporate debt-ridden companies out there that have taken on way too much debt because it has been way too cheap over the last decade, and none of them prepared for a situation like this where their entire potential income stream gets shut off for months. And so how they prepare to go forward and what they give as their guidance for how they're going to stay afloat and how they're going to be profitable in the future and all this sort of stuff, that is going to be this key main question during earnings season that could start to spook a lot more people out than are thinking right now, right? Most people are still just thinking in terms of, oh, this is short term, short lived, and yeah, these companies had to shut down for a little bit, but they're going to be back and they're going to be better than ever, right? If you start to give these millions of people that have just been throwing, a few $100s each into Robinhood and making speculative trades, if you give them some information of how financially unstable these companies really might be, they might really take a step back and go, oh, maybe I shouldn't be throwing this money at these companies that I don't have any idea about. And if they stop buying in, the market stops going up, right? So I'm going to leave it at that. But that's going to be the big key question to watch with earnings season. And we're going to see a lot this week. The banks start tomorrow morning, Tuesday morning. All the big banks report this week. I don't expect their earnings to be very good at all, especially after the Fed announcement that happened a few weeks ago about their dividends and share buybacks and what they're allowed to do and how much liquidity they have to keep, all this sort of stuff. I don't expect the banks to be good. But as we get to, these other big brand name companies, this is going to be the thing to watch. And that's going to be the thing that, as I've been saying since March, I personally think is going to trigger the next wave of volatility. And we very well may have seen it start today in the form of California reshutting down. So I'm going to keep it at that for this week. I'm sure a week from today, we're going to have a ton to kind of go through and look back at. As always, hit me up with any questions that you have individually. But definitely a time that things might get a little bit more dicey. So just be really cautious and safe with the positions you're taking, because this is a big time. You can make a lot of money right now if things start to get volatile, but you can also lose a lot. So just make sure you're making smart decisions and have your trades outlined the right way, and we'll take it from there. So have a great week. Talk to you guys soon.